Good afternoon and welcome to our corporate finance project. We analysed and compared Kingspan and CRH from the construction industry. Our project team consists of myself, Alan, Eddie, Stephen and Trevor. The global construction industry is notoriously cyclical in nature, with a project orientation which has led to a boom-bust cycle over time. Both of our companies come from humble beginnings. CRH was created with a merger of two companies in 1970 and Kingspan was founded in Cavan in 1965. Notwithstanding the inherent challenges in the sector, CRH and Kingspan have successfully delivered constant annual market share, turnover and profitability growth and have emerged as significant players in an international context. Both our companies are listed on the main security market and are required to comply with the UK Corporate Governance Code and the Irish Corporate Governance Annex. CRH have a Type 1 agency relationship. Their main shareholders are institutional investors. Kingspan have a Type 2 agency relationship. The majority shareholder in Kingspan is the founder of the company. Institutional investors are known to promote management accountability and increase efficiencies. However, institutional involvement is not always a good thing. When the institution decides to sell, they would often bull sell, which will lower the price of stocks. Having a dominant shareholder can be a double-edged sword. The dominant shareholder will want to make the firm profitable, ensuring future growth. The downside of the generational view is that it may lead to risk-adverse decision-making. They may choose not to complete mergers and acquisitions if this would alter the control of the firm, potentially increasing the values of the shares for the minority shareholders.
While coronavirus and Brexit have presented significant economic challenges to all Irish companies, both CRH and Kingspan have remained largely insulated against those challenges. In the case of CRH with regard to risk, international credit agency Moody's allocated a credit rating of Baa1 to CRH, indicating a moderate to medium risk profile. This was based on good product diversification, a high degree of vertical integration, and exposure to stable and less capital-intensive materials than their international rivals. CRH also has shown significant diversification in 3,000 locations across 30 countries. These strong credit metrics are based on revenue of a drop of just 2% despite the very challenging economic climate. CRH also have an enterprise risk management framework to mitigate against uncertainty and a further risk governance structure, a further matrix of over 12 levels to consider ongoing risk. Like CRH, Kingspan showed strong economic performance based on a fifth consecutive year of net profit and double-digit ROCE. Kingspan showed 1.3 billion in cash reserves as at December 2020, thereby providing purchasing power to mitigate against any risk from potential rising interest rates or credit risk. In their financial report, Kingspan, like CRH, outlines strong credit regulation and oversight in place. And again, key to their insulation from risk is Kingspan's diversification globally across 70 markets and also diversification into green markets such as light and air and water and energy. These are key to success in an era where customer environmental concerns are intrinsically linked to the product's deliverables.
Thanks, Eddie. We'll now turn our attention to capital structure choices, which have a direct effect on the valuation of a company, and careful consideration should be given to achieving the optimal balance between debt and equity to maximize overall company valuation. The weighted average cost of capital, or WACC, is a calculation of a company's cost of capital in which each category of capital is proportionately weighted and is a direct result of the capital structure decision-making process of those charged with governance. WACC is directly correlated to company value creation and can be used as a minimum hurdle rate when assessing whether a company is generating value or not. WACC is a critical input variable during the capital rationing decision-making process at a discrete project level, but can also be used on an overall enterprise basis to assess the operational efficiency of a company when measured against return on net assets, or RONA. Managers must be careful to balance the merits of debt versus equity and weigh up the control and tax advantages of debt, where interest is tax deductible, dividends are not, where equity cedes control to external parties, debt does not, but this must be balanced against the risk of financial distress as debt escalates, whilst understanding that the value of a company is maximized by an optimal balance between debt and equity. Generally speaking, an optimum level of debt as a percentage of equity, otherwise referred to as capital gearing, is 50%. The following graph displays the capital structure of CRH over the last 6 years on a net debt basis. We have chosen to use net debt as a result of a financial statement restatement of debt and cash equivalents in accordance with IAS 32. When adjusted for net debt, we can see that CRH has an average capital gearing ratio of 40% over the 6-year review period, with a figure of 30% at the end of FY 2020, which is significantly below the optimum threshold of 50% and reflects a strong financial position with headroom to raise additional debt finance through a bond issue or other financial instrument of approximately $4 billion, which coincidentally happens to be the amount of undrawn credit facilities available to the group at the end of the most recent financial year. Using a comparison between WACC, calculated using the dividend capitalization model at an average of 4.7% over the past 6 years, and RONA, we have established that CRH has a strong record of value creation with RONA in excess of WACC in all 6 years, with 2019 and 2020 being particularly successful, with returns of between 6 and 7% in excess of cost of funds. Turning our attention to Kingspan, whilst it was important to present the capital structure of CRH on a net debt to equity basis, it is more appropriate to display Kingspan's ratio on a gross debt basis, as shown in the following graph. This graph shows an escalation of Kingspan's capital gearing ratio to 65% in 2020. Following a loan drawdown of $752 million during the year, the company is now in a higher quadrant from a gearing perspective, and it would not be prudent to raise any more finance through bond issues, loan drawdowns, or other debt mechanisms, as this could lead to financial distress. However, it is critically important to note that whilst this loan was drawn down, it was not deployed to any strategic or operational projects and remains in cash, with resulting net debt to equity of 10%. This cash was drawn down to strengthen the balance sheet in uncertain times as a result of the COVID-19 pandemic, and if not required for any value-adding projects, should be repaid immediately. Again, using a comparison between weighted average cost of capital, using the capital asset pricing model for Kingspan, due to the volatility of their dividend payment process, they have a WACC of 5.1% over the past 6 years, and return on net assets to measure Kingspan's operational effectiveness as it pertains to value creation. We can see that management are performing extremely well, with double-digit value creation in each of the last 6 years. This compares favorably to CRH and suggests a strong outlook for the future in terms of market capitalization and overall wealth creation and operational profitability. It also suggests that Kingspan have an effective capital structure with cost of capital significantly below annual operational returns. This graph illustrates the operational effectiveness and success of the Kingspan management team of marrying an appropriate capital structure with strong profitability metrics, which should lead to substantial long-term incremental value creation. Mergers and consolidation. Mergers and acquisitions can facilitate sustainable growth over a shorter time frame than organic growth and can lead to greater profitability outcomes, where the acquiring company can benefit from economies of scale by leveraging the infrastructure of their existing business physical, capital, and human resources to achieve higher returns than would be possible at the discrete company level. The development of dynamic capital management as a core competence has led to significant financial strength, which in turn enables CRH to fund its proven acquisition model through lower capital costs, maximizing and optimizing investment returns. CRH are the gold standard in Irish business circles in terms of their acquisition strategy and have embedded the practice as a core competence within their business to such an extent that they execute an acquisition every 8 or 9 days. Over the 5 years from 2015 to 2019, CRH invested $15 billion in their acquisition strategy. This investment resulted in a compound annual growth rate CAGR in turnover of 1.5% and net profit of 16%. This suggests that not only are acquisitions a critical strategic growth pillar for CRH, but they are essential to maintain existing business levels. Kingspan's 1.5 billion investment in its acquisition strategy appears to be more focused on growth, with the group achieving CAGR rates of 11 and 15% in turnover and net profit respectively over the 5-year period from 2015 to 2019. It hasn't been all good news though, as the EU competition regulators have opened an in-depth investigation into Kingspan's planned acquisition of Slovenian-based manufacturer Trimo. This highlights the risk and challenges involved in pursuing an acquisition strategy and the importance of developing a managed process to mitigate against all risks and to ensure successful onboarding of the target.
CRH and Kingspan both have a regular cash dividend policy that aims to pay in 2 instalments. This allows the board to decide on the interim payment if trading conditions change. However, whilst this appears to be the case for Kingspan, CRH have paid a consistent dividend over the past number of years as a reliable return to institutional investors. Kingspan's dividend policy has been reactive to prevailing market conditions, and there have been 2 periods in the recent past where dividends have been cancelled, in 2008 and 2020, in response to the global financial crisis and the COVID pandemic. However, to further demonstrate the reactive nature of Kingspan's dividend policy, the board have revised their decision on the 2020 dividend cancellation in response to the improvement in annual performance, and a final dividend of 37 cents per share was agreed at the AGM. The following graph demonstrates the clientele effect of CRH dividend policy, where overall nominal dividend payout and dividend per share have both stayed relatively consistent over the past 6 years, despite substantial undulations in EPS. This reflects the positioning of CRH shares as a long-term stable investment that provides regular and consistent returns to the shareholders, protecting the share price from short-term market volatilities. Kingspan's dividend policy is in stark contrast to the consistent payment approach adopted by CRH, with a higher degree of volatility. This approach results in a dividend payment directly related to operational performance, which may influence the type of clientele that will be attracted to this share, which may lead to volatility in the share price and market capitalisation, as the shares could be prone to trading on a more short-term basis than CRH. I will now hand you over to Stephen, who will discuss the company's valuation.
To determine the value of a company, we can use quantitative financial analysis such as the price-to-earnings ratio and price-to-book ratios to evaluate whether a company's share price represents good value based on comparisons to industry. The CRH price-to-earnings and price-to-book ratios are both higher than the industry average, which indicates that its share price is overvalued relative to the sector average. Historical earnings growth would also appear to support the opinion of CRH being overvalued. If we look at historical earnings growth figures for CRH, we can observe that over the past 5 years, CRH has had significantly lower than expected growth rates of 6.9% compared to the industry average of 17.9%. Looking solely at the ratios and historical earnings above would suggest that CRH is overvalued currently. However, these metrics do not take into account the non-financial qualitative associations which may be driving the share price and attracting investors to the stock. CRH is a leader in the industry, employing over 77,000 people across 3,000 plus locations. These figures most likely give CRH a competitive advantage based on economies of scale and can help CRH to weather the COVID disruption better than smaller competitors who may not have the same level of product diversification and geographic distribution. Moving on to Kingspan. We can see that Kingspan has a price to earnings ratio which is over 1.5 times the industry average. This indicates that the company stock may be overvalued when compared to the average across the building sector. Kingspan's price to book ratio is greater than double the industry average, which would also indicate that its share price is overvalued relative to the sector average. Historical earnings growth, however, would appear to contradict the view that Kingspan's shares are overvalued. If you look at historical earnings growth figures for Kingspan, we can observe that Kingspan outperforms the industry over the past 5 years. We also need to consider qualitative variables to better understand Kingspan within the investment context. In the building industry, there is a drive towards consolidation. Kingspan is positioning itself to become the dominant market leader through mergers and acquisitions. These M&A efforts will drive continued growth, deliver economies of scale, and help Kingspan to weather the expected impact to the construction sector caused by the COVID pandemic.
Thanks, Stephen. Now we turn our attention to strategic recommendations under the following headings. Under capital structure for CRH, based on their current capital gearing ratio of 30%, we recommend they draw down the $4.4 billion committed loan facility as outlined in their 2020 annual report, which would optimize gearing at 50% and support further strategic growth and sustainability projects. Secondly, in future, where possible, CRH should focus on raising bonds in the euro market, which typically carry a lower coupon of less than 2%, 300 base points lower than the average US dollar bond yield currently in place. For Kingspan, we recommend they repay the loan drawdown of $752 million immediately if not required for strategic value add purposes. From a dividend perspective, we recommend Kingspan review their dividend policy in the context of market capitalization and develop consistent strategy to maximize valuation of the company through shareholder expectation management. Under mergers and consolidations, we recommend Kingspan review their internal controls in relation to the identification of competition authority risks as they pertain to acquisitive growth. They should review and refine their M&A process, considering the TIMO challenges, and execute preventative actions to prevent reoccurrence. For CRH, as the gold standard in Ireland in relation to developing M&A as a core competence, we recommend they consider developing a syllabus to commercialise and monetize the process and offer out to the market. And finally, my number is 087 93 137 if CRH are interested in replacing Sen and Murphy with somebody equally capable. Thank you very much.